be going live here on YouTube any second now. And with that being said, I've got the big green light, excellent connection. We are live for another monthly show with TradeStation. Specifically, we are here with David Russell, their head of market strategy. And as many of you know by now, he runs the TradeStation account on TradingView, which is consistently creating, I believe, what is some of the most important information to read about charts and markets. You can essentially catch up on any big moves happening in the markets if you follow their account on TradingView. And David Russell is going to be guiding us through what he's seen in markets today. And by the way, we're going to be going through many different asset classes, including crypto, specifically Bitcoin. And now it is important for me, before I hand it over to David so we can kick the show off, to say that this show is sponsored by TradeStation, and TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures, and futures options markets. And with that being said, David, I'll hand it over to you for your readout so that all of our viewers get the full breakdown before we dive into markets at a deep level.
Well, great. Well, thank you, Seth. It's great to be back with everyone. I'm just showing a few disclosures. I'm also going to show the standardized returns of some ETFs because we may discuss those. We do have a link that I believe we're sharing in the chat of how to see some of the prospectuses on ETFs as well. So thank you for bearing with me on that. And now these are the standardized returns. Let me just make this thing come up. There we go. Right here, some standardized returns of some of the ETFs we may discuss. So I'm going to just quickly show those. You know, Steph, I wanted to start off by kind of three big things I think are kind of important. And I think, you know, like anything, it's sometimes important to look at the bigger picture in anything to understand, because sentiment is such an important part of financial markets. And I do believe that we have some major sentiment issues here and also some structural things that people are becoming aware of that will impact sentiment. So the first point is, from my perspective, we're in a spot here where Goldilocks could be more or less setting in as we speak. And I think that's important because if you think back, we talked some time ago about how Tesla's chart 6 to 9 months ago was really bearish. And then the bad news came. Charts see things before the actual news hits. And we are now seeing the S&P basically telling us that a really good macro environment are coming. So what are those things? First of all, when you look at the job environment, we see continuing weakness in the employment environment, continuing claims rise. Now, it might sound bad, but what does it mean? It basically puts the Fed now on a pretty probable path toward rate cuts. The next thing is we're seeing oil inventories going up. The government yesterday said that last year, American oil production exceeded consumption, 4% up on production, 1% up on consumption. It was the biggest gap in history. So what does that mean? America producing more oil. Also, OPEC coming apart in terms of its unity. That is also an overall positive for inflationary trends. When we look at what's happening in treasury markets, the Fed came out and took away rate cuts in their dot plot, and the treasury market moved the other way. So what's interesting, if we look back to 2021 and 2022, the bond market, the yield shot up before the Fed even was getting hawkish. And what that means is the market was ahead of the Fed, and now it's just the opposite. Back then, Jerome Powell was saying inflation is transitory, then he had to play catch up. Now he's saying inflation is, you know, still here, and the market's saying we don't care. So this is the exact opposite behavior of what we saw at the beginning of the hiking cycle. Now we're seeing bond yields going ahead of the Fed and seeing that inflation is coming down. So that's the big thing here. We have a Goldilocks environment that seems to be good and getting better. Another thing about it that's important to realize is that earnings growth has been improving, and we're set for double-digit earnings growth this year and next. Some of the internals that come from people like FactSet, if you look at some of their weekly reports they put out, we are seeing smaller downward revisions than is normal, which normally would actually points to the direction that things are breaking in a positive direction in terms of each of the incremental news and the estimates that come out. So that's the Goldilocks scenario. The second thing I think is something important to realize is we have had an incredibly negative sentiment environment in American financial markets for a very long time. And what's interesting is things like consumer sentiment have been abnormally negative when you consider the job market and other things. I believe for various reasons that American society is overly negative. I speculate it's because in many ways, millennials came of age during the financial crisis, and then we had one weird thing after another. And on top of that, we haven't really seen millennials move into their century, so to speak. We're still living in the baby boomer century of things like, look at the presidents. They're both relatively old guys. So we have a situation where I think we're now getting to the point where millennials are going to start to look out and realize this is my bull market. It used to be my parents' financial crisis or everything else, but now we're in a spot where they're going to start thinking about their own future and thinking about their own retirements and thinking about their own investing and seeing their own incomes go up and seeing their own economic boom. And as I think that happens, I think we're going to start to see sentiment improve. And what's interesting is we have the presidential debates tonight. So even though that might not have any real impact, the real thing is we have been in a spot where sentiment is too bearish relative to the data. And so I think that as that turns, people will have more ability for risk appetite. The last big point I want to say is that we're in a point of secular expansion of the American economy and the American society and workforce. We have more people entering the workforce. And, we basically have, as the end of the global financial crisis, that stuff is ancient history now. But basically, as things like construction start to pick up, we went through this long period of underinvestment, and all that now is turning. And finally, we're at a spot where the economy is actually now more based on things like healthcare, which are actually less cyclical. So we have an interesting environment now of an economy that's getting stronger. At the same time, it's going to be less volatile and less at risk of recession. So I think, if we could fast forward 10 to 15 years from now, we could see that this is actually a very interesting environment for equities if we were to look back on this moment. And I think it's opening up in front of us. And I think that's why the S&P has not been able to put together any kind of big pullback.
So there's a few things I have to comment on that you said that I think is not only important from an educational standpoint, but what's happening in markets now. The first one was how you kicked off that introduction about Tesla. And I think you said something along the lines of charts see things before the news hits. And that made me think of a great quote. I forget who the trader who said it, someone from many years ago, but he said something along the lines of show me the charts and I'll tell you the news. Right? I'd love that quote because there's some sort of element of, the smart money's moving markets, not moving markets, but, they're involved in markets. They obviously don't want to lose money. They have tons of resources, research, they're diving in. So they probably can, gather information maybe a little faster than the traditional news cycle. So I thought that quote was really interesting. And then I want to comment on the other aspects about millennials and the bearish nature of markets right now in America. But bearish sentiment, because actually we're kind of in a bull market at the moment. But before we go into that, I noticed that you're annotating the Tesla chart right now. And so on that line of charts see things before the news and what you were watching in Tesla, very popular, heavily followed. Walk us through sort of what you were looking at on the chart.
Well, back here, we had done a story. I don't have all the markups on this individual chart, but there was some stuff here, the 200-day moving average. But basically, we did an idea on this. I'm not sure. It was somewhere in here. If you look back on TradeStation's, channel on TradingView. But basically, it was the same thing. I mean, our point was the S&P was hitting new highs and Tesla wasn't. Period. End of story. Who cares about reading analyst reports and reading the chart told you all you need to know. We then proceeded to have a bunch of bad data in terms of deliveries, price cuts, all this other stuff. And it told us. Now, I think it's interesting here if we go back to the weekly on this. This is the thing I was just marking up for my own use here, is that we had a false breakdown recently, and now it's been holding and turning up. Now we're looking to August 8th with the robo-taxi event. Now we have job cuts. Now we have some interesting analyst notes saying that the product cycle is going to improve. So I'm not really sure here what to make of Tesla, but it's interesting that now the market might be actually seeing something different in Tesla. But yeah.
I think though it's kind of a theme of our show too, with all the new traders out there, that introduction and now breakdown of Tesla, I think people will really find value in that the charts see things before the news. And now in terms of the sentiment, I also have to say that is fascinating. I see the same thing. It seems like, in fact, someone's in the chat right now asking us to talk about, the US government debt. That probably does attribute to some of the bearishness. There's a big election debate tonight. You know how people don't feel great about that. So it is fascinating that all of the headlines around us are telling us to be pessimistic and bearish, but the charts, are holding up. You said about the S&P 500, there hasn't been that big significant drawdown yet. And that is, what I think about often is your chart of the money market supply. Maybe that is kind of feeding into the S&P 500, but maybe walk us through what you're seeing in the, yeah, look at that. Wow. Walk us through what you've got annotated here and what you're looking at.
See, these are some older things I have in the S&P. If you don't mind, can we start with the 10-year? Because I still believe
Okay,
that
yeah, let's do 10
that's
year.
really and we've done this a lot. And I think it's really important because, we've talked about the 10-year here, how basically it went up to like 5% last, October, and it made this lower high. And this was a weekly uptrend that really started back when the Fed was hiking. And you can see now how we've gotten under it. We had talked a lot about 432 as a level that went all the way back to the financial crisis. And basically, in my view, staying under this gives the sort of sense that, the top is likely been established in yields. And I think we see this here. We have this uptrend that we're now holding under. And if you look back, and I'm flipping to the daily, but there was this big gap. And this was back in November of last year when we started getting some data that really started to suggest that the inflation was getting better. And it was a productivity number, a relatively obscure number, but it really impacted sentiment that day. Look at how we went back and stalled at that gap in April. Lower high, lower lows on the weekly. Now we're under the flat line. We're under the trend line. And at this point in time, I think we have to look out. And what do we see? We basically have, Jerome Powell is speaking on the 2nd. Then we have Fed minutes on the 3rd. Then Jerome Powell. Then we have payrolls. Then we have Jerome Powell speaking in Congress on the 9th. And then after that, we have the CPI on the 11th and another Fed meeting. So I think we look out now. There's all these events coming along. And the question is are we now in a spot of some consolidation here, followed by a more significant break to the downside in yields? And if that happens, the entire narrative of negativity is really challenged at that point. And we could, I think, see something get more optimistic and more positive, even with the gains we've seen in the S&P this year.
I like that you have the June 2008 highs marked there as well because of the significant historical moment that represents a really large financial crisis. And look at that. Wow. See the resistance there. And so it's very, catches my eye to see that even right now at this moment, yeah, we're almost hitting it right now. So super interesting. And as many of you know, interest rates are important because they apply to everything from home loans to car loans to so much more. So they do drive the economy. And I would say that, are you observing that essentially, are you sort of seeing the trend getting weaker? Is that kind of what you're alluding to? Or do you think it's going to chop sideways a bit?
In my perspective, we have PCE tomorrow, probably not a huge event. My suspicion would be that the things to really watch are going to be July 9th, Powell is in the Senate. July 11th, we get CPI. In my perspective, somewhere in that 48 hours of time, we will know the future of interest rates. And given the trends that we've seen now and what the market is already showing us, there's a chance that it's going to be more to the downside on rates. And essentially the Fed's hawkishness that we saw in that last dot plot was actually an artifact. It was kind of like when he said, oh, inflation is transitory and we're not worried about it. I think we have to look back at that psyche of how behind the curve he was in late 21, when the market was thinking the opposite. We have to take that and just do the mirror image of it and think that we could actually be right now in that time when the market says inflation is already going. And like I've said, we see evidence of this. It keeps coming anecdotally when you look. The housing market continues to see an increase in inventory and listings. And what's going to happen is as rates come down and people say, all right, now I can move. As they look to move, I know you're looking to buy a house for the first time, but the thing is a lot of people who own homes, as they are ready to move, they're going to list their houses. And when a person decides they're going to move, they have to make that house sell. So they're going to start cutting prices on the listings. Inventory will increase, prices will come down, and then the people who are in apartments will, as they leave the apartments, the rents will come down. And this big chunk, which is more than a third of CPI, as this pulls down, that combined with what we're seeing in energy, those two things alone, but then on top of it, throw in the higher continuing claims. All these things together put us in a spot where the Fed, the odds and the probability of the Fed breaking more in a dovish direction now is increasing. So the thing is, I think we have to realize with Powell speaking in Congress, the CPI, and then the Fed meeting at the end of July, we're in a spot here where somewhere in the month of July, we could really see this direction be established to the downside on the 10-year yield.
I want to comment on the CPI breakdown that you just illustrated, and also how that relates to inflation, which I think people forget. Another great educational comment about this show, which is oftentimes we see headlines that say things like, inflation is up X percentage, or inflation has jumped, or inflation dropped. But people do forget that it's made up of a basket of goods. And I thought that was pretty cool that you are looking at the actual components that go into that, like rent. So it's interesting that you could have a basket of goods going up, but maybe rent dropping hard enough or fast enough to where it can pull inflation down. So I just think that's a little important note for everyone watching about really looking into the actual components that go into all of these headlines and essentially what oftentimes drives things like interest rates. So on this chart, you just marked down a few key events here. Which events are those?
It's CPI, which is on the 11th. I think, let me just confirm that CPI is on the 11th, which is Thursday the 11th, and Powell is speaking on the 9th. So those are big events, and I think people should put them on their calendar and just have an awareness that, if things are going to break, the likely, we also have payrolls before that. From my perspective, if it's a really weak number, that might have an impact. I think overall, though, the CPI is really what's driving this trend now more than employment overall. So, I think it's important just to remember that event on the 11th.
We got Powell's testimony coming up, which David has marked on the chart. Ladies and gentlemen, maybe you want to set a reminder yourself, use the economic calendar, make sure you're really paying attention to that. In fact, someone in the chat just wrote, those are big events in Forex. And I thought that was an interesting comment that, we don't cover Forex too often. Sometimes we look at the Euro USD and other pairs, but I'll just say to you in the chat, yes, you are correct that these are very important moments for Forex, but also, as David's illustrating, for equity markets and more as well. So, it's awesome. You put the dates there for people. What else? What else do you have for us in terms of the chart breakdown as we move through this, almost top-down approach?
All right, so the S&P 500, there's a few things here, and I wanted to actually add some stuff to this, which, what's interesting to me is we are actually, the way we've been holding this high is very interesting to me, because I was expecting a pullback to 5,400, and, we went down, and, it's always dangerous to assume that an old high will become a new low, to think that resistance will become support. It's safer to look for support at an old low. So I have been kind of thinking a test toward 5,400 was likely. But at the same time, we've been holding above this. Now, we had this bearish outside day back here on the 20th, but I think it's interesting just to see us holding above this high. And, from my perspective here, we're at a spot where there's a few things. Well, let me first of all put in RSI. We've talked about this idea of, RSI cooking. And, I think that's, an important concept, this idea that when the market is in a real positive uptrend, and I'm not going to do this, but if you go back and look at 1995, RSI basically stayed around overbought for like an entire year on the S&P. And that was, again, we're making comparisons in 1995, and I think it's important to realize this is pretty similar. We go up to this overbought and we stay there. So what's interesting is we had this pullback, and then RSI basically went back to overbought for the first time since February. So my view is that we are now actually entering another up leg of this market, and or potentially entering. And I think the first thing we see is RSI went overbought for the first time in several months. So RSI is just kind of pushing these highs. It's not retreating, and that can be a sign of overall strength. That's the first thing I wanted to mention. The next thing I wanted to do is I wanted to put on one of our custom indicators. And this one is moving. It's moving MA speed. Where is it? There we go. All right. So now this shows the speed of the 50-day simple moving average. It's very interesting if you look when the market started rallying. Now I can actually put the 50-day moving average on here, and you can see that it turned positive and this turned positive. So what's interesting is as the market kind of accelerates, you can see essentially that it moves, that it accelerates as the market does, and then it naturally slows in terms of its speed. This is the actual rate of change of the 50-day moving average. So what's interesting here is we basically took this big pause, and then if you look, we accelerated as we got back above and the 50-day started up again. So what's interesting is when this thing starts moving higher, it tends to mean, typically it will move down and it will diverge. So it'll start to give divergence before the market stops. And what's interesting here is not giving us that. It's actually giving us confirmation. This is an intermediate term trend indicator, and it's giving us confirmation that the intermediate term trend is actually accelerating. So I think this is another signal that popped up. I was watching. I have a series of charts and I just look at them, and like some of them will give you a signal once every few months. And I had noticed this, and I had kind of noticed how it basically, it kind of went sideways, and you can see we went under the 50-day, and this was just a period here really of all March and like May was essentially a period of consolidation. But now we're back above it. And so I think that's an important thing. So we have RSI going overbought. Again, during this entire period, RSI did not go overbought. Then it goes overbought as the 50-day starts rising more sharply. These things tell me that we're entering a period of acceleration. Now, the last thing is another personal indicator I use, which is the 10-day simple moving average. But what's interesting about this is I have another indicator here, which is called MA streak. These are ones we have published, just so you know.
I love these.
On our TradingView channel under scripts, and some of these are quite old. We've had up for a while, but personal. I'm sorry, I want to look at personal MA streak. And what this shows is how long a moving average is moving in a certain direction. And it's just when it's falling, it's a negative number. What's interesting to me is that this is essentially a time measure. It doesn't tell you price per se. It doesn't tell you magnitude of move. It simply tells you how long have we been running. And you can see when the 10-day moving average is rising for maybe 40 or 50 sessions straight, that's when we're getting complacent. But if you look at this, we are really not in anything complacent here. The 10-day moving average can continue rising for, historically 30, 40, 50 days sometimes. If you look at it, and we look back here, if this was maybe the highest back here, in September of 2020, it rose for 47 candles. Right now, it's up 16 candles. What does it tell us? It just tells us that right now, we are in a spot where the market is actually not in an extended period of upward movement. And so, again, this is also telling me that we could be in the earlier stages of an expansion. So I just think it's important here that I know the market's been hitting highs, and it's easy to say, oh, it's overbought and it's a bubble and all these things. But when you really step back and look at some of these indicators, we had a period of consolidation that resolved to the upside. We had a period without a lot of being overbought, during which we had, we worked off the giddiness that we saw earlier in the year. And we're seeing the acceleration of the 50-day moving average. So you put those things together, and I think we're in a spot where, erring on the side of trusting the trend might be more that what favors people.
So these indicators, since we started doing our show, I've really grown to enjoy, and I hope others have too. Specifically, I like the MA speed a lot and MA streak. I'll say to MA streak, which I thought was really interesting, that I had been looking at prior to our chat, and now I even see it on this chart, is actually, I wouldn't say, performing technical analysis on the actual indicator in the terms of like looking for tops, like double tops. And I think what's actually really cool about what you have there too is you can see the streaks. There's sort of a historical reasoning to the streaks, like how long can they go on for? What's the longest? What's the shortest? What's the average? And so I found that these indicators are actually rather helpful, not for specifically just trading, but actually for just general research, like how long can this go on for, and are we in the early innings based off of some of the other streaks that this specific symbol has gone on in the past. So I hope others, by the way, are taking notes of these indicators, because you all have created these, correct? These are coded by TradeStation.
These are if you go to our profile and you go to our scripts, not the ideas, but the scripts. I want to add one other thing about this, which I think is another way to use this, is if you change the MA streak and instead of the 10-day, you set it to a 1-day, it essentially tells you how many days up and how many days down. And what's interesting here is that this was a 3-day drop. 3 days, it's calculating, but 3 days of consecutive downside is actually relatively uncommon. So we basically had 3 negative days. I don't know why this is, my computer was being strange. But anyway, this is, we have not had 3 consecutive, I'm going to just, I don't know why it's doing this. I'm going to just give it another number and see what happens. There we go. Let me just change it now. But the thing is sorry about that. It's unusual to see 3 consecutive negative days. And when you consider we had 3 negative days without even going under any significant level, this is not working right now. I apologize.
You know what I think it might be, by the way, David, that's interesting, is it might be because it's on the index, the S&P 500 index, because I think it's generating the script based off of possibly the closing data for the index, right? I bet if you did on the ETF,
price streak.
There you go, price streak.
I meant to do price streak.
Gotcha.
On TradeStation, on TradeStation, I have a custom indicator that does that. For some reason, this one doesn't work with that on this script. But I'm sorry, this is price streak. But it shows the same thing. That we have this big drawdown here when you look of multiple days to the downside when we were just in a clear kind of pullback. But if you look overall, and it's not to say that that 3 days is an incredibly long time, but the fact is 3 consecutive days to the downside without any real breakdown. It's an interesting sort of thing that again tells us it's like, that's all you got. Is that all the sellers have in them? Is that they can basically pull back maybe 1% from the high after that. And it just kind of tells you again that the sellers are not active. They're not in charge. And that's really just, I think, one of the things here. So, yeah.
Can you tell us about price streak? I see someone wrote in the chat that they're learning. So tell us about price streak really quickly, about what it's representing.
It just tells us consecutive days or candles in any given direction. So,
gotcha.
So in this case, it's like these are, when you see here a value of 6, you can see that we had 6 green upside candles.
Got it.
So, and the thing I would add is that when you do technical analysis, it's easy to get obsessed with price, and it's not just price. There's also time, and just to kind of recognize that sometimes we simply need to let time pass, and that's kind of what these do. I mean, I spend most of my time looking at price, and I kind of created these to kind of put my brain right back in the spot of actually saying, like that thing with the 10-day streak. All right, we just started moving, and to realize, all right, let's take a step back. Now is not the time. When you're hitting new highs and he just started, ascending, now's not the time to be getting bearish. We often want to get bearish too soon or bullish too soon when something is dropping. And just to say, all right, let's take a little bit of time and just respect the fact that time is happening. So, so those are things in the S&P. I got some other stuff I want to get to if you're ready for it.
Let's do it. Yes, let's keep moving.
Right.
We're doing the top-down approach. Macro, and now it looks like you got Nvidia queued up.
Yeah, I do have Nvidia queued up, and I want to show something here. I have something very special here. This is a relative strength indicator. And what I did was, and I'll say one of the things I absolutely love about TradingView is you can just really quick and dirty create like a custom stock or index or something. I'll show you over here. This is basically all of the mega caps minus Nvidia. So I basically added them all up. This is Amazon, Tesla, Meta, Microsoft, Apple, and Google. So what's really interesting here is you can see that they had this kind of rally and consolidate here. And at the same time, if you look at the NASDAQ in that period, the NASDAQ actually pulled back all because of Nvidia. So what I think is interesting here is, and one of the points I want to make is, after Nvidia had that big bearish day, I think on the 20th, what we have seen is we have seen money move away from chips into Apple, Amazon, Netflix, Google, Microsoft. All the other large mega cap stocks, including Tesla, are now getting that money. So the chips rallied really hard. They were overextended by various measures. They completely dominated price action in kind of May and June. And now we're not seeing, you know, the sell-off or the weakness in Nvidia spreading. All we're seeing is people rotating into these other names. And again, I think that's actually a really important point to make here. So this just shows that. Now in this chart, I took that same list and I added to the indicator called the relative strength, which measures the top chart against an index. In this case, instead of putting in an index like the S&P, I put in the list of Amazon, Tesla, and these guys down here. And what's really interesting to see is, you know, with a kind of a 5-day performance, you can see this drop in Nvidia was actually very dramatic relative to these other large cap names. So the big point overall here, and my main point, and I don't want to get too, you know, arcane with the charts. My big point is that as Nvidia pulls back, Meta is breaking out, Amazon is breaking out, Alphabet is breaking out, and that Apple is continuing after its breakout. That's, I think, the big point that I wanted to make here.
So okay, so if you go back to that Nvidia chart that you had, I feel like this is a masterclass for some of the traders and investors out there, specifically about how you're doing this comparative analysis between a basket of equities and Nvidia. Could you explain what you've coded up at the bottom of the chart, just in case some people don't fully understand what you've built here?
So there's an indicator which someone else created called relative strength. It's one of my, I have it marked as a favorite. And basically it'll, you know, it automatically brings in, it looks like this when you first use it. And so it will compare the top symbol to some kind of index, and it uses the S&P by default. So I basically changed it and I put in this list. I simply went like, you know, I just went like Apple plus, you know, Meta plus, you know, AMZ, and I'll just do those to start, put it in. And now you, instead of the S&P, you've created this custom list as the benchmark. But then the other things I did was I went and I changed the style to a histogram. And then I made it, I like yellow instead of the blue for this. And actually I should make it thicker. And now you can kind of see its performance. And this is a longer time frame. This is set to 50. This is only set to 5. But if we change it to 5, the key thing is that this is one of my favorite indicators. It allows you to see how things are performing against the overall market. And you can see here it shows this similar sort of performance. So that's essentially what we did. We kind of, you know, because like everyone says, oh, Nvidia is dominating the market, but then what happens? We're essentially just taking that away and creating a NASDAQ without Nvidia. It's essentially what this does. Because if you look at those names, they would dominate the NASDAQ, you know, ex Nvidia.
And this type of comparative analysis, I also think, is great because it just stems back to how you kicked off this part of the show. This part of the show segment is the money is now flowing to other areas. It's not just chips. And the chip run up was, I mean, you only see that once, I feel like, every few years in a specific sector. Super microcomputers, Nvidia, even Qualcomm was booming lately. Just look, you can see the run up. There we go, the SOX ETF.
Yeah, and I think this is you know, important because this was you know, it's actually not, I don't know if it's a bearish outside day, but it was on Nvidia, and this is a big reversal day. And you know, if you look back, we just look at Nvidia for example. I mean, you can see this is a bearish outside engulfing candle, and you know, we had another one back there, and it consolidated sideways, you know, for a couple of months. And I think, you know, now it's kind of behaving similarly. It's under the 10-day. I'm not sure how much I care about the 10-day on this chart, but the key thing is that you had that reversal. And now what's interesting is there's a weekly low here that it's trying to hold. It also had about a 50% retracement of a breakout above this old high. So if you go from the old high and you go up, it's kind of at a 50% retracement. However, in my view, I think when you look at the history of something like this, you got to just realize that, all right, we've now expressed what Nvidia can do for the next few months. And I think that the market is ahead of the news. We've now expressed the strength in that area. And it's like, well, how about Amazon? Let's not forget about Amazon. Suddenly out of nowhere, breakout. You know, Google, out of nowhere, breakout. Apple, it's like, oh yeah, remember it broke out last week. Oh, out of now, continuation. And today we did a trading view idea on Meta, which is also kind of sneaky, just hanging out here, not that far from its old high. It had that, look at it, had that bad earnings report, and it didn't make a new low after. It just came right off those lows. And, so a lot of these things, I think we just have to realize here is that Nvidia has dominated this, but it's not like the other names are breaking down, and it's not like their fundamentals have problems. Excuse me. And I think the other thing we have to realize is Apple, as they do AI, is going to become more of a service business, less of a hardware business. That means multiple expansion. The other thing that's interesting, and I want to just kind of point out that I'm noticing today as I look, is the incredible strength in the software space. So if you look at all these names like Palo Alto Network and a bunch of these other software names, is it CrowdStrike that's doing well today? There was a few software names today that were really coming off the lows. My point about that is that software names are valued a certain way. And in many ways, what Apple is becoming is more analogous to a software company. When rates were high, people didn't want the software companies. When the cyclical economy was strong, people didn't want the software companies. But as we move back now to a lower rate environment, as we move back toward a kind of less cyclical environment, that is an environment that starts to favor software companies again. And as Apple becomes more of a service provider because of AI, you have a double whammy of the service growth accelerating, it's high margin, and it will become more favorable from a macro perspective when we are in a lower interest rate environment, which means that all those things could now become positive for Apple. So I think, again, Nvidia, it was great what it did, but now we can actually look onto these other names and people can see potential opportunity. So I think that's what's really happening in the market here, is that basically Nvidia is not the end of the story.
And I'll say to the Facebook aspect too, which I think is rather interesting, is Facebook has so much data to work with when it comes to AI and its AI models. And it does strike me, even that chart that you were showing, it does strike me as kind of a sneaky AI play. And they're probably sitting on the largest amount of user data. I mean, they have conversations from basically everyone around the world in all different languages. They can build probably some pretty fascinating tools with the amount of data they have. And, I'll say to Apple, Apple's breakout did surprise me. I'm not sure if people watch that Apple event, but I was very interested to see that they're partnering with ChatGPT and OpenAI for some tools. It kind of hinted at me, though, that are they not able to build it themselves? So I was actually very surprised to see Apple break out the way it did. But hey, they're pushing into the AI space, and it's very, I think eye-catching to observe that this breakout among other tech names, even such as CrowdStrike, like you pointed out, is now occurring. So the capital does seem to be rotating a little, and maybe Nvidia did get ahead of itself. One comment I'll say to Nvidia too is, I think I read something along the lines of a percentage of their workforce are now just like sheer millionaires because of the run-up. And a lot of them are selling equity and just quitting. Like they made it. So
interesting.
Yeah. So there's this comment of they might run into a real, problem with their workforce because they're going to lose talent, that they almost made it too quickly. Thought that was interesting. I see you have Adobe up.
Well, it's another software name. It's just interesting to look at these software names like Oracle. And I think this is one of the things when you suddenly take a step back and you realize, wait a second, a lot of these companies like Oracle, they're not dead. Adobe's not dead. They're still around. And, I think that's actually the point here is that we're now simply seeing, and it's interesting, we're near the end of a quarter. Maybe another time we can talk about my 7 catalysts for stock movement. But I basically have a list that I sometimes talk about. And one of those is investor rotation. And we often see around a quarter, people will kind of shift from one to the next. So the thing is, right now, if you're thinking about allocating capital at the end of the second quarter going into July, do you want to put new capital into chips? Or do you want to look for areas that maybe are starting to get new? And I think that's really the point now, is that you're going to see some rotation. People take profits on things. Nvidia is also at a point now where on a 12-month basis, it is up a lot, obviously, as we know, but that also means people can now be selling this and taking those long-term capital gains. So you're at a spot where there's less and less incentive to be holding Nvidia and more incentive to be ringing the register on it to a certain extent. And these are just kind of basic things. So I think that's important to kind of think about. And I'm just noticing as I look around, and these are not necessarily charts in and of themselves that are hugely important, but look at Datadog. Here's another one of these kind of, there's some companies, I view them as these are like the high multiple stocks that did incredibly well in 2020 and 2021 when rates were low. And they've been dead in the water, for a long time here. But look at Datadog rallying here. Look at Mongo Database. It got crushed recently.
I remember that.
Now it's kind of fighting back up. Now, these are names that are not necessarily like, charts that have great setups. But what we're seeing here is some strength in software. And that's also just kind of interesting. It's telling us that money is successfully rotating out of chips into other growth areas. And I think that is the takeaway, as we end the quarter.
So to our 600 viewers so far on this live show, David, when he kicked off that segment, mentioned that he's got, I think, 7 criteria for spotting specific moves or breakouts, I guess.
Yeah.
We should absolutely make that a show. We should just make the show titles that, and we should dive into that for a whole show. But I say that to our 600 plus viewers throughout this show so that you can subscribe and get excited for our next chat, because I think that's what we might have to do, these 7 criteria.
It's not as technical, but it might actually help understand how some of the things, why charts do what they do. So that'd be great. We'll do that. All right, now
we did want to keep the charts flowing.
Yep. All right. I had to just mention, energy to me is an area that I have been kind of perpetually negative on. And I think it's important also to realize that the data, we had a big build in inventories. We've seen a lot of evidence here of things in the oil market that are not bullish. And I think it's interesting to look at the XLE and see that it's in this kind of downtrend. We did an idea on Schlumberger yesterday that was essentially, pointing to some potential resistance at the stock kind of hitting this level right here. You can see that on our ideas on TradingView. But I think right now, it's just interesting just to realize that, to me, energy here is at a spot where there's this trend line coming down. This is the XLE, but this might be something of people looking for downside here that, it's interesting also that it bounced at the 50% retracement in May and it didn't hold it. So that's also kind of interesting. Everything you look at here, just kind of suggests to me that this is, something of a downtrend. And again, that's positive for everything else. But you wanted to ask about gold, which I thought, was interesting because
David, and let me say before we go into gold, I just want to say to the people who have been in our chat during the show, some of you were asking about gold when we kicked the show off. This is for you. So let's dive into gold. And they asked for this exact ticker too.
Yeah, and I've been kind of looking at this because, to me here, there's a spot where there are some important kind of levels here in terms of just holding essentially in this range. And we have this falling trend line. So I think for me, what matters is we're holding a 50% retracement of this breakout above the high from 2020. That's the first thing that matters. But I think after that, we have to go back to that thing that we started with, which is a 10-year treasury. And in many ways, the euro, which we don't get into that much. But the thing is that the euro is in this triangle here. And I think that, this is, let me take these off. I'm just kind of looking at this. Essentially, how the euro is in this large kind of sideways movement. And in my view, as long as it doesn't really have a major breakdown and a major rally in the dollar, the euro is probably not going to be some kind of huge outperformer. However, if the euro kind of holds its ground and we simply don't have a huge rally in the dollar, that alone could be the thing that keeps gold essentially. This is now back to the weekly of gold, but I think this could kind of put gold back in focus on the upside. So the key thing to me is it's holding this breakout with that 50% retracement. It's just kind of sitting and lurking. And I would say the same thing. Powell on the 9th, CPI on the 11th. Those are going to be the things to watch if gold wants to break out. I think it's giving us the signs here it's giving us positive signs that the longer term breakout remains in effect. And I think we simply have to wait until the catalyst triggers that.
My number one comment on gold is essentially the size of the breakout from the triple top that I think lasted since, exactly. Yep, triple top. I mean, it didn't really triple top. It kind of retraced when it hit there, but since 2022, it's surely one of the larger technical moves to almost a textbook that I've really have seen. And so that has really fascinated me. It took it several years to break out above those 2020 highs, and then it did. And yeah, you got that nice pattern mark there that maybe it's flagging, perhaps it's bull flagging. So definitely an interesting point here for gold. And by the way, I would add just quickly why it matters so much is the sheer market cap of gold is just enormous, right? I think if you add up all the gold out there by its price, by market cap, I think it's the largest asset on the planet. I think 11 trillion, something of that nature. So it's hard to move this asset to this point.
Well, I think the thing is that we see a fundamental story of what's happening globally. There is a shift of central banks using it. There's all this talk about there being a BRICS currency or something like that. And it will probably have an aspect of a 19th century gold standard, the way the British pound was, something like that. This idea of there being a non-dollar trading system between Russia, China, India, these big economies. And you're talking about, some really big economies. So, I think that there's a fundamental story in place as well, for something like gold. Again, people get all worried about the American debt and the economy and all that stuff. And I mean, you got to be careful about things like that because you can worry for a long time about something that isn't important now. And I think the important thing to remember about markets is something can linger and be true for a long time before the market wants to express it and act on it. And I think the thing is that if we are going to one day have some giant collapse of the American, financial system or the treasury market, maybe that is coming. I'm not going to predict it. The thing is we're going to get some kind of evidence of it on the charts, and we're not getting it now. We're getting instead the idea of the treasury auctions have been strong. And I think that that's a key thing. But the other thing that we are getting evidence of is that globally, gold is being used again in a way that has not been used in 50 to 100 years. And that is potentially something that's interesting. And as these global central banks look to amass gold and overseas people look to hold gold, that is something I think that we need to be aware of as a potential trend. And I think, again, those big events in July, let's have them on the calendar and be ready. So I got to get to Bitcoin, though, because, I am really not a big crypto guy, but I am interested here in what I'm seeing. This Bitcoin is the one I look at. And what's interesting to me is I have some markups here that are now kind of obsolete. But what's interesting is we do have this old high. Let me just, if you guys don't know how to do this, I always use these objects on the right. I can drag this down. So it basically overwrites that, and I can quickly go and then adjust this, move it to the text to the right. All right, so we're back to this old high from, back here. I don't have it drawn all the way across. But I think what's interesting here is essentially, for me on the weekly, is it looks like we're trying to hold the lows on the weekly basis. And I think that's really interesting here. We're holding around that 60,000 level. And it's interesting. We actually had an area here, this price zone. This is a chart I usually use Bitcoin on a different chart. But you have these old markups on that you can come back to. But look at how, again, this was a level that we had marked several months ago, back in like April or something. And here we are coming down to essentially hold it. And I think we're at a spot here where, leaning more on the side of glass half full might be what the market is doing, because we essentially have, if this holds, we have essentially a high basing pattern potentially above 60,000. And I think that's interesting. We're also seeing that this big breakout we had back here in February, we held it. So I think this is, to me, a pretty interesting sort of setup on the risk reward side where things might favor the upside. On a very short term, what I thought was interesting is I was looking at this one. If you look at coming off the lows here with the Fibonacci retracement, was it today we basically held that 50% coming off the low. This is a 15-minute chart coming off of, right around 6,500. 60,500, but we held a 50% retracement of that move. So I am just saying, like, right now, it's a spot where sentiment has gotten a lot more bearish. You can make the argument simply based on positioning that people are bad news has been priced in, negativity has been priced in, and now if there is a spot for the pendulum to swing, this might be that spot. So I think it's kind of interesting.
I have to say also on that notice, there's a lot of people who have had multiple chances to build a Bitcoin position over the years, maybe got scared by the euphoric jumps and then simultaneously scared by the euphoric drops. So I always am wondering about Bitcoin of like, when is there a steady sort of non-volatile drawdown that people sort of feel comfortable getting involved in? Because some of the crashes in Bitcoin's history have been so fast or swift that it's, the famous buying a falling knife type of aspect. And so, not to do that. That's that adage. So the chart you're showing also catches my attention just from the standpoint of, wow, it's almost like stabilizing. Like you can actually watch it and be a little patient. You don't have to feel like it's flying upward or downward. So that's just my observation of the moment. And I'll also say, just for the viewers out there, David, your Fibonacci retracements are just they're my favorite. I don't know anyone who draws those Fibonacci retracements in a clearer, more clean way. It's just, here's your 50% retracement, bottom to top, done. So I really like the way you do that. The viewers may learn something new from it as well.
Well, the thing you see is sometimes you see something rip and it catches your attention. And then, I think essentially you can take a step back and draw that 50% retracement and see if it holds. And that can be sometimes a pretty reliable way to just tell you, was that rip the beginning of something? And then you just look for continuation. You don't try to understand it. You don't try to understand why something is happening. You simply understand it seems to be happening. And from a trading perspective, that's often the better way to go. The problem with fundamentals is when you think about them too much, they take your mind off of the things that's actually happening in the chart, and you start arguing with the chart, saying it should be doing this, it should be doing that, and that's a bad way to approach, trading, and it's a good way to make mistakes. So, anyway, I think it's interesting. The one thing I'll add is, this level, and I'm not sure why I drew this thing the way I did, but it went back to April. There must have been some intraday levels that made me draw it. It's very interesting to see that was the level that we held, and now this is a potential false breakdown. It failed it could not stay under 60. And that's all I have to say. A false breakdown is a potential bullish reversal pattern.
For all of I was just gonna say, for all of our Bitcoin viewers, that was for you. I know we haven't covered Bitcoin. In our last show, we didn't cover Bitcoin, and maybe not the previous one either. I think that was a nice analysis that they all just got. And, we'll do a reminder to cover Bitcoin a little more often in our shows. Okay, the Russell 2000. Oh, geez. I mean, small caps, they can't catch a break.
No, I know, but they're just doing nothing. And I think the thing again is, I think we have to realize that this can be the kind of environment when, this is not over-owned. There's unlike Nvidia, where people are up, several 100% and might ring the register. You have environments here. And I think that as a quarter begins and things like that, if yields do move lower from a risk reward perspective, there's a lot of arguments in favor of people keep talking about small caps are going to do well and blah, blah, blah. But I think the key thing here is, again, we have some interesting levels. It's holding more or less 2,000. We have this falling trend line. And I think it's important that, this is now in a very tight range. And this is a sort of thing that, if it closes above this trend line and starts to move, there's not a lot of entrenched longs. And the other thing is, it's not that far away from its 52-week high. This could be something that kind of just starts expanding before you know it. So I want to just kind of put that out there to be aware of, because again, the new quarter, rotation to new things, small caps, there's been this argument about small caps and why they should be good for a long time. And that argument probably has some merit from a fundamental perspective. The thing is that, again, maybe it hasn't been the time for it to play out. But if we get to a spot where the interest rates start coming down, then suddenly a lot of those arguments might actually start to express themselves in the chart and actually have, some importance and some influence. So I think we got to just watch this because it's just been lurking.
I have so much to say about small caps, but before I go into that, you said the word new quarter, and I think you also mentioned new quarter a little earlier in the show as well. And for all of our viewers, I don't know how familiar they are with that type of look at markets, whether it's a new quarter or not. And I do know a lot. It's a kind of an institutional way to look at markets. Maybe you could just shed light to everyone, viewing why you are interested in new quarters.
Well, one thing is that there are quarterly reporting when people actually show what their holdings are at the end of a quarter. So there is an incentive, like there's the idea of window dressing when like everyone wants to show it Nvidia on their books at the end of a quarter, something like that. And that's a historical thing that's actually kind of played out. But I've simply noticed that these rotations happen and quarters correspond to earnings seasons. It's just a logical way for people to think. And I think that ultimately institutional money, I mean, obviously there are retail investors, but the institutions are the ones that truly have that underlying, they're the real base of buying and selling in the market. And that's how they express things. That's how they do their reports. And I've just noticed that you find these rotations around quarters. And I think we have to, just kind of respect that. And it doesn't mean that it's one of these things when you say, I think something is going to happen, and you're saying it on like June 10th, you might be right. But maybe the simple lesson is wait until the end of June before your expectation, before you get too excited about it, because you might be right. And then you look back, because I've seen this many times, you look back later and you're like, what did I miss? And then you realize I should have just waited for the quarter. I should have just waited for earnings. There are events out there that are often the kind of linchpin that everything swings on. And that's what I'm trying to do by focusing on those events in July. I'm trying to say, if we are going to get these things, like if gold is going to take off or something like that is going to happen, it's important, I think, just to have these events in our mind, to know that if something's going to, that's the actual, pivot to be aware of. And it just happens sometimes. And it's a big use to kind of be aware of them and think that way a little bit.
Great breakdown for all the viewers out there who aren't familiar with that type of sequence of events specifically related to quarterly reports, or the concept of window dressing, or funds who have to report their holdings every quarter. I just think that those are the type of concepts that's why we do our show, so we can teach people a lot of these things that they may not be familiar with, because they're more so on the institutional side or sort of the back office side of large funds. But they do, adhere to these quarterly reports and reporting methods. So very interesting, I must say, and I hope some people caught something new there. I'll say this, David, we crossed our hour marker, so we've kind of hit our show point, ending point, unless there's anything else that you have to let the viewers know. I know sometimes you remind people of the upcoming events to watch. We did that earlier, but maybe there's something else that you think is worth noting before we wrap up.
No, I think at this point, the biggest thing, like I said, is I think that we are in a process. We're in a process essentially of the improvement of the economy that started late in the, in last decade. It was interrupted by COVID, but those structural improvements in the economy are playing out now. And then we had the inflationary thing that is now fading. I think it's more important to realize that this is a process. There's not individual events that matter as much. And the other process is earnings accelerating. Those, I would encourage you to take a look at some of those expectations for earnings growth this year and next. So these are bigger forces that are playing out, kind of in the background or under the market.
Hey, you know what? One thing we didn't talk about, and maybe it doesn't matter to markets at all, but I just have to ask it. There's the presidential debate tonight. Do you think that has any impact on markets, or just it's already priced in and not as big as we think at this current moment?
No, I think it does. And it's not the debate itself. The thing is, election year is going to be positive. And I believe that we're going to be in a spot when sentiment toward the economy is going to get better. People are going to start talking more positively, and the political environment will become more positive for sentiment. This is a historical pattern. And I think as people focus more on the election and they start to feel better about things one way or another, this, I believe, will allow us to shift away from the gloom we've been in toward more of a sense of what an election year feels like. And it's been a long time since we've seen these patterns play out, but they can play out.
I think that right there is the ideal way to end it, because I'll check out the debate tonight just to see what's what's going on, and I'll be interested to see the viewership numbers after. There's some.
The last super quick point
Yeah.
is it basically the sentiment, the same way it might not get any worse for consumer sentiment, the sentiment toward Trump and Biden might not get any worse. And if people just start to feel, I don't, if their popularity, either of them just goes up, that allows a degree of optimism toward the country and the economy that we haven't seen.
And it's interesting because it will bring the economic conversation to the main stage. So
Exactly.
it almost might feed on itself. Hey, maybe markets are at all-time highs. It starts to percolate throughout society. I mean, it's a great point. Just the debate alone brings it to the center of attention. Well, David, with that, we'll wrap up. I hope everyone enjoyed the show. As always, be sure to follow the TradeStation account on TradingView. Subscribe here to make sure you get notifications about every live show that we do each month. And as you all know, David runs the TradeStation account on TradingView. So be sure to follow for the ideas, ask questions, engage with his account, and he's there creating content. So it's been a pleasure, David, and we will do our next show next month.
Thank you, Steph. Have a good one.
See ya. You too.